Terrific. Thank you so much, Rolly. And it's great to be back. And thanks for having me. Of course, I understand Mike's in Australia. Well, I'm an Australian myself, but coming to you from Mexico. So there's the Globetrotters of Australia that we're known for. But this is a very, very, very exciting topic to be discussing. And perhaps many of you have heard me speak about this over the last few months. We've been talking about this since late October of last year. Of this crash that we're currently experiencing. And today I'm going to be talking to you about obviously how to capture the crash, how we predicted the crash, and what's coming next. Just a quick survey of the audience. Was anyone part of our webinars recently over the last few months talking about the crash that we saw coming? Or who's hearing this for the first time? All right, a few first timers, a couple of people from past. All right, well, yes, obviously this is going to be a wonderful topic because this has been probably the most money we've made in the last 3 months in the history of my trading. Our corporate trading account is up close to 300 to 400% just in the last 6 months, and I'm going to be sharing with you what we're trading, how we predicted it, and how to predict it going forward. So now, if this it is because I'm coming to you from a DSL connection, which is the best they can give me at the location I'm at. So there may be a bit of a delay, but we'll try and keep up with that. But firstly, before we get into the nitty-gritty and talk about the technicals, I want to talk quickly about some psychological things as we go through today's slides, because most people, and I was just listening to Hubert talking about this, and Hubert's a great trader and a good friend of mine. He talked about the fact that a lot of people fail to take action. You have to do something to make money. Most people fail in the stock market because of that reason. People do not take action, and they do not take action because they do not have rules, or they do not have confidence in those rules. And those are that's a major psychological problem why people don't jump in and take opportunities, they don't get in or out of trades at the right times because they're waiting for that confirmation, and by the time it's already too late. I find that the main reasons for these problems comes back to 3 main points. Is that they either do not believe the rules that they're being taught, or they don't believe that the market is predictable, or they don't believe that they themselves can do it. And so as we go through all of the content today, things that I hope that we can overcome as we progress through today's workshop. So the very first thing I'll bring up is this slide. Now remember as we went into Christmas and everyone said, the Christmas rally is coming. And that was one of probably the biggest loads of you-know-what that I've seen in a while. This was of course, Goldman Sachs talking about the market's going to be rallying off into the skies above. Of course, we know what to make of that these days. What we saw coming towards the end of the year and from October on, and what is still coming now, were key elements that indicated that the market's set for a big drop. Now, just to cut to where we think our target is 1600. So we believe there's a lot more problems yet to come. And that's what we've been trading. Now, of course, one of the first things you might say is, well, why listen to us? And so I wanted to share with you, we are real traders, and everything that I'm going to teach you today are things that we take action on ourselves. And I'm just going to share with you, this is just the trades I've been doing this week. These are all trades that we send out to our members. And as you can see, very few losses, but quite significant gains across what we've been trading. So today we're up about sent out yesterday. So we do trade these. We do exactly what we teach, and this has been off the premise of ignoring all of the noise in the market and focusing in on what the real smart money is doing and how we track that. So what we is the big one. Now, these slides haven't changed since October. These are the same problems that have been unraveling. Obviously, the Asian economies and what's been happening in China is a massive problem. We have seen big issues in the impact of the Chinese economy and now the European economies weighing in, and China still hasn't even opened up after its obviously after its New Year's holidays. So we could be set for a 10-15% drop in the Chinese markets when we open back on Monday. Of course, a long weekend in the States where investors won't be able to react to it. So I can't imagine many people wanting to stay long going into the weekend. But there's the first problem. We've got the overseas economies. What happens next is this starts to result in major bankruptcies. Now, we haven't seen this yet, but there is immense pressure on the worldwide economy with one of the major contributors to demand being China going sharply south. We've also got $7, under $30, I think it was $27, $28. Think about how many oil companies cannot make money at that price. And think about how many banks have funded those operations that will be defaulting or on those loans when those companies go bankrupt or what have you. There's many pressures. But what happens is whatever the first domino is to fall, and that could be a major company like Lehman Brothers, or it could be a country. Puerto Rico, of course, already out of money. Can't feed the prisoners in jail. Can't pay the teachers. This is a U.S. country, a U.S. place. So as you start to see the dominoes fall, credit tightens. Banks no longer want to lend. Companies find it difficult to borrow. Consumer credit contracts. People stop spending money. One of the best trades we've done this year or last year was buying puts on Polaris, PII, that makes snowmobiles. One of the reasons, of course, because it's a company that makes snowmobiles in the hottest winter we've ever seen. But secondly, if people aren't going out and buying jackets and clothing, which is why Ralph Lauren and so forth has been plummeting and other apparel wear, then they sure as hell aren't going out buying new snowmobiles. And this is just some of the first indications of problems. And as that occurs, this has major implications for the market because investors liquidate. Who right now feels like they should go and remortgage their house and take their money and go start loading up on longs today? Anyone in the audience feel that way? And if you're not feeling that way, what do you think happens? People start liquidating their mutual funds. ETFs are forced, therefore, to sell the stocks that they hold. And the bubble that bursts, $600 trillion of speculated value in the economy. Now, that figure, that's the amount of derivatives or speculated value. That's like me borrowing, you giving me $100, and then me borrowing $1,000 against it and investing with it. Now, that extra $900 is speculation of a speculated value. It's not real money. It's paper that doesn't exist. And the amount of paper that doesn't exist is estimated at 600 trillion. And that number, if you don't know how big that is all of the real estate in all of the world put together. So when you start to figure out how big the bubble is, that's why people are loading up on gold. And yes, gold is doing excellent. In fact, we bought calls on NUGT, which is the triple bull on the gold miners when it was at $25. It's currently at $53.90, one of our best trades this week. And yes, I agree with you, but I think it's going much higher. Maybe not today, but higher certainly. We'll talk about NUGT later and gold. But that's basically where you see that the high earning ratios or the high P/E ratio companies are just getting slammed. So this is where you start to get really great opportunities. Companies are no longer spending money. The companies are in survival mode. Look at the amount of mergers and buyouts that have been going on for companies just to be able to combine assets and resources to survive. So think back to 2008. What did we learn from that? You know, what have you done differently? Or what are you doing differently now that you learned from the big crash in 2008? If we're not changing our strategies, then it's just insanity. So let's talk about how we can predict this market. Firstly, when we talk about the idea of doing the same thing over and over again, let's talk about the second point that people fear, that the market isn't predictable. So I'm going to take us back quickly to 2008. I've got the weekly chart here. And let's firstly talk about why the market is very predictable. The market is very predictable because of the way that it works. 80% of the volume is estimated to come from high frequency trading. In other words, computers that make decisions purely based on rules. And these rules are derived from patterns. Just like watching the Super Bowl, each that they're going to utilize to win. And the playbook in the stock market is patterns that the high frequency trading or market makers utilize to move the market and to know when exactly they're going to buy, where to push the market up to, where they'll sell, and so forth. One of the most highly probable patterns, and in a bull market when it's about to reverse, is the head and shoulder pattern. So let's look at how 2008 built up. I'm just going to go to a longer time frame here. Excuse me as I just adjust the chart. Okay, so let's look at 2003 up to 2007. What you'll notice is that we were in a long, sustained uptrend. And then right at the end, in March of 07, the pattern broke out. And as soon as one pattern ends, that's when we start looking for what is next. What's the next pattern happening? And that channel ended, and we saw a new pattern begin right there where the vertical line is. So when did the crash of 2008 begin? It wasn't in 2008. The crash of 2008 began in April 2007 when this head and shoulders began forming. And we had a beautiful left shoulder, a head, a right shoulder, and then as we go over to the right-hand side, let's measure from the neckline to the head. There we go. We'll make that line a little bit bigger or thicker. Okay. And then we measured the breakout, and that's exactly how. Okay. Then we rallied up. We made another left shoulder, another head. All right. So now we'll measure from the head to the neckline. We'll push, and then we'll measure from the breakout point. That was our next key level to where it should break down, 1,000. And that is exactly where the key resistance was set as we then dropped further. And what you might notice is then down the bottom, what we actually formed there was an inverse head and shoulder. There's the left shoulder, there's the head, and if we measure from the head to the neckline, you'll actually see that that's exactly where we rallied back up to as the market recovered. So is the market predictable? I would say so, given that the chaotic major meltdown in the market was perfectly measured with one simple pattern, if you know what you're looking for. The second thing, so let's fast forward to today. In October of 2015, in the Capturing the Crash webinar we had on October 16th, I drew these two trend lines. These two trend lines have been on my chart since 2015, October 16th. And I said, I believe that we have come out of another long-term channel and we are forming yet another head and shoulders, just by looking at the symmetry of the up and down nature of the way the S&P 500 had acted, and then of course confirmed as the way we rolled over in this beautiful head, which is when we then started doing our second series of Capturing the Crash in December. We predicted an 1810 low and then a bounce back up to 1940. We did. Up to there, straight back down, and you can see we've now completed a beautiful right shoulder on this head and shoulder pattern. So what would be next? Well, if we measure again the head to the neckline and duplicate it beneath, that gives us a 1600 target of the next stop on the S&P. So that's the first thing. The next thing we want to look at of how so the patterns, firstly, is one of the most important things as a technical analyst. People often ask me, how much do the fundamentals play into my decision making? Well, I believe that no matter what I think or what I feel about the information I read, it doesn't matter, because no matter what opinion I may take on a company or the market, someone much smarter with a lot more influence over the market has already made a much more informed decision. So whether they're right or wrong, they are right, because if the smart money loads up on a stock, it will go up. Whether it should or shouldn't, the fundamentals don't matter. What moves the market isn't fundamentals. What moves the market is money. And 80% of the money is controlled by the smart money, the high frequency traders, the big boys and girls. So whatever I think really doesn't matter. What matters is, what does the people who can move the market think? Where are they taking things? And one of the best things that I like to look at, or one of the first things I'm going to show you that has an immense role in all of our decision making and scanning that we do, is looking at an indicator called Twiggs money flow. Now, once more, let's go back to 2008 crash. Now, as you can see, the entire time that the market rallied over 03 onwards, the Twiggs money flow, or smart money market, there was no major divergences or big changes. It just kind of flatlined along as the market pushed up. Now, what is the Twiggs money flow based on, firstly, to give you an understanding of the why behind why it's important? The essence of a true uptrend, or a lot of people think that an uptrend is higher highs and higher lows. Would everyone agree with that? That is the typical definition of an uptrend: higher highs and higher lows. However, that is very dangerous, because what if the stock was making higher highs and higher lows, but the range is contracting? What if the stock is making higher highs and higher lows and the volume is dropping at the same time? What if it's making higher highs and higher lows, but closing lower and lower in the range? Is that an uptrend that you would buy? Absolutely not. In fact, that would be a perfect short if we had the volume dropping, candles contracting, and closes lower in the range. That would be something that I would load up on as a short position. So let's define what a true uptrend is. A true uptrend that we want to buy is something where we're making higher highs and higher lows as volume increases and we close higher in the range, and ideally the candles are expanding. So if that is occurring, a true uptrend is in place, which means the smart money are buying and holding. They're accumulating a position. And that's what the Twigs money flow puts together for us, is all those factors. And so what you can see down the bottom is you can see a representation of, is the smart money loading up or is it selling to you as the market rallies? And what you can see is from October 06, where that head and shoulders began to form, that was when the market went up and the smart money started to diverge sharply down. Once more, let's fast forward to current days. Again, market rallying through 2012, 2015, smart money trend stayed with it. What do you notice, however, from June 20th, 2014 onwards? What was the smart money doing? And yes, I can zoom in there for you a bit. What was the smart money doing from, oops. I'll just make the chart a little bit bigger there for you. Selling. And that is, again, one of the key factors of any chart or any stock that we look at is, what is the smart money doing? So we looked at it from a perspective of the pattern. We've looked at it from the perspective of the money flow. And one of the other indicators that we can look at as a true signal of what the smart money thinks of the market is to look at a symbol called HYG. Now, if we look at HYG, this is corporate high. So what that means is that if bond traders, of course, some of the most educated traders out there, they're the CEOs of the Fortune 500 companies. They're the big boys and girls. And these people buy bonds. They are the smart money. Now, if the smart money believes in the health of the US market, stock market, the corporate world, then they invest in corporate bonds, corporate high yield bonds. So as markets recover or crash, these will normally move in unison. As you can see from 2009 onwards, as the market recovered, so too did the corporate high yield bonds as smart money invested in corporations. However, what you can see from 2012 onwards, this flatlined. In fact, it formed an ascending wedge, which is a bearish or rising wedge, which is a bearish pattern, and then broke down from that point onwards. So does anyone know, of course, what events coincided from 2012 onwards? What were some of the key economic things that changed in the market around that time? Quantitative easing. And so what you can see here is that as the S&P 500 climbed and climbed and climbed, the corporate high yield bonds plunged. So when we start to see divergence, that's how we get the edge in the market. That's how anyone makes money. It's not about doing what everyone else is doing. It's looking for the BS. It's looking for where one thing doesn't make sense against the other, and finding that niche, finding those great opportunities where it just doesn't add up. Why is a pharmaceutical company selling at 600 times earnings, and just before they announce their earnings, every single person in the company is selling millions of dollars of stock? That doesn't make sense. In fact, some of our best trades have all been based on some of these key factors of just looking for where smart money is loading out and the pattern confirms that a drop is ahead. And as you can see, the high yield bonds already making record lows from over the last few years. So the stock market hasn't broken the lows yet. We're just edging into that head and shoulders pattern. You can see that the high yield bonds certainly have, and the volume is picking up sharply. So those are some of the key factors that we look at. So when we start to look at trades, Hubert mentioned Amazon. I can remember people were asking about Amazon. Well, absolutely. In fact, I hold puts in Amazon that I just bought, which we bought as it broke down below 540. We sold those puts when it hit 480, and we bought back into them today. As you can see, as Amazon, and I'll just zoom in a little bit, and I'll just simplify the chart somewhat here. So as you can see with Amazon, what happened? Amazon climbed higher and higher. What was the pattern? Well, the pattern was an upward channel. An upward channel is bearish. So typically after 2 or 3 touches of support, it will break down. So we got one touch, we got one touch, 2 touch, 3 touches, break. And there was the perfect time to short Amazon, was actually up at 640. Pardon me. What was the smart money doing? Well, as Amazon went higher, what was the smart money doing when we look down the bottom? Selling to you, or to someone, because there was billions of dollars being bought, not by me, but it was the perfect time as we broke down through that pattern. The money flow confirmed, and there was a shorting up since that breakout point. We've now since broken the 200-day moving average. Money flow continues to drop, and we are now in a momentum mode where the stock cannot even break above the 5-day exponential moving average, which shows a very rapid decline. That is Amazon, absolutely. Let's look at the next thing we can look at. Then once we've looked at a perfect pattern like that, we can then very quickly look at exactly what the smart money is doing by .com, punching in AMZN. Oops. And we can see what the smart money was doing. Selling millions and millions of dollars all the way through the year. And not just one person, but a whole mirage of every different name and directors that you can point your finger at. Talk about another trade. RBC. Okay. This stock rallied straight into resistance. What was the pattern? Once more, upward channel. Bearish. This upward channel came to an end as it hit resistance on the 50-day moving average. Money flow turned down sharply, and on the hourly chart was very divergent. So as it broke that channel and bounced down off of resistance, they had earnings the next day. So we went in and loaded up on put positions. Of course, you can see next day, gap down 7.95%, another 1.68% yesterday, and still falling today. We actually bought more puts today. Let's talk about another company. Oh, well, before we do that, there's the insiders. What can you see? Hardly any action on the insiders, and all of a sudden, at the end of the year, selling at a P2E ratio of 48 in the industrial sector. Okay, well, let's go on to another one that you may be interested in. CRI, Carters. So they're in the textile and apparel goods. I'm not sure if anyone's been watching the clothing business, but it certainly hasn't done very well, plummeting. And this one was one that came up in our scan just a few days ago. And again, let's have a look at the long-term chart. If we zoom out and you look at the trend from 2014 onwards, this company was very well held up by this line. That was the major uptrend. Now, as the stock climbed and climbed, what can you see the smart money's been doing? Selling and selling. Once more, we zoom in. And you can see after it broke down, it rallied straight back up and tested that line from beneath, and has plummeted straight down since then. And as you can see, beautiful break from, once again, an upward channel movement. So, and the smart money, straight out. We can go to, once again, have a look at the insider cow. And what do you see from the CEO himself? Selling record amounts right into November. So these are the key things. I mean, we talked about kind of the three things. Do you believe that the person teaching you has the rules? And of course, Trading Pub is a fantastic place to meet real traders that do have systems that work. So that problem hopefully should not be an issue for most people here. And confidence in those rules. So when I trade something like Carter's, which I'm holding puts in at the moment, It's never a question for me of, do I like the company? Do I read the news? It's purely looking at, does this trade meet my rules? Is it a high probability bearish pattern or a low probability bearish pattern? So if it's a low probability pattern, if it doesn't fit exactly what I want to see, I'm not going to trade it. Just because I could make money on the trade doesn't mean I should trade it. It has to be a high probability pattern. There's 100 patterns out there, and you've got to know the difference between what are high probability patterns and low probability patterns. That's the first thing. So if it's a high probability pattern, check. Okay, is the smart money selling off in droves? Check. Have I got a high risk to reward ratio where I can get in right at resistance and have at least 3 times more profit than I stand to risk? And in some of these trades, it's 10 to 1 that we're holding at the moment. Check. And if all of those rules, basically, if you've gone through the checklist and you've got a tick in each box, there is no thinking, there's no feeling involved. It's simply, right, does the trade meet my rules? Take it. And even in this crashing market, I've still taken longs to hedge against my shorts if the longs meet my rules. And the beauty of that is when you have rules that you can confidently believe in, where you do not think at all, you simply act just like a high frequency trading system would and trade it if it meets your rules. You never have to worry about going to sleep at night and worrying about the market the next day. Because you know that if you've got 3 to 1, worst case scenarios, if at least one of your trades works out, you're at least not losing money because it covers the losses on the other 2. And if 2 of your trades work out, great, you're making really good money. And if 3 of them make, then you should be very happy with yourself. So you never have to worry. It's always about your entry and exit rules. So with everything, you always trade your systems. This is another one that we shorted, ALNY. Alnylam something or other pharmaceuticals. Once again, have a look at the system. As you can see, as the stock went sideways, what can you see the smart money doing? The smart money absolutely loading out of the stock. Stock forms a rising wedge formation. Stock broke formation. So we went in and bought $75 puts. And I think we bought those at about $4. I sold one of those yesterday for 18. And still holding one position, one contract left in this one. Now, the reason I sold it is because you can see it's coming down to this key support where this entire rally came from. So the target on this was always to get out at this price anyway. So this was the rules. The symbol is Alpha Lima November Yankee. And the second reason that I got out was, once again, following my rules. The reason why I got in the first place was, you can see massive insider selling. So that was the first check. And that was one of the confirmations of why we got in the first place. Coming into earnings tonight, we can see that we've reached our target. So there's no thinking involved. Has it reached the target? Yes. But also, one of the reasons why we like the trade in the first place has changed. We now have a large amount of buying coming from a 10% owner, 205,000 shares bought at $69. So one of the elements that made this a perfect trade is no longer there. And that is enough as a technical analyst to not think and simply follow my rules and say, right, the recipe has changed, out I go and go buy some Amazon puts. Right, so no thinking. We're gonna have a look at another one. Let's have a look at Red Hat. Also one that we've loaded up on puts on. Have a look at the same thing. So Romeo Hotel. Have a look at from February 13 all the way up to November 15. November 15, we've got a massive upward channel. 1 touch, 2 touch, 3 touches. We break through the 200-day moving average and 150-day moving average. We zoom in, and what can we see the smart money doing the entire time this stock was creating the last series of highs? Selling. So as it broke, again, following the support right there at 73, loaded up on puts. Now I've talked a lot about options, but I didn't start trading options till probably about 3 years ago. I built my portfolio, my career as a trader, and Acorn. Acorn's been around now almost 9 years, but built it off trading stocks. Because I firmly believe, as I've shown you, that the market is very predictable. It's organized chaos because of the nature of who trades it. It's high frequency. So I believe firmly that the levels on a chart where a stock will bounce between, and when you know when you've been proven right or wrong within a few percentage points, which is where you get your targets and so forth, and stop losses. So whether you want to trade options or whether you want to trade stocks, everything comes back to knowing where are the levels, where is the high probability pattern happening, and once you know once you're drawing your trend lines on a chart properly, you know what the pattern is. If you can draw trend lines correctly, there's no guessing, because if you've drawn the trend lines correctly, you know the pattern. If you know the pattern, then you know the rules of exactly how to trade it. And if you know the rules of exactly how to trade it, there is no guesswork. There is no fear. There is no greed. It's purely rules. And once again, with Red Hat, 61 P to E ratio. So a very high P to E ratio for a very weak sector. And again, tons of insider selling. So I'll come back to questions here in a moment. Do we offer recommendations as well as education and training? I send every single trade I do, every single trade we've done over these last few months, I send out via text message. We just started the text messages actively this month. So we send out a text message saying I'm getting in at this point, I'm selling. We also send out a video almost every night with about 5-10 minutes called the executive summary, and that summarizes the positions that we are going to be buying tomorrow or getting out of tomorrow, the entry point, the exit point, the stop loss, and what options we may be considering. So I'll talk about how that all fits together, and then we'll see how much time we've got left for questions towards the end here. Un momento, por favor. All right. So I've talked all about these rules. Now, the trick now is, okay, well, how do we use these? How do we take what Johnny is telling us and go and make money with it tomorrow? How do we systemize everything that we've just been talking? Because what I've been talking to you about is the why. You know, the why behind the system, the rationale behind why we trade this way and why it works. And before I ever send out a trade alert, I want people to know why. You know, everyone, oh, this magical piece of software that's going to make you millions of dollars. Fine. But I mean, whether it works or doesn't work, I will never use anything unless I understand why it works. Now, not everyone's like that, but that's how I teach. I want everyone to understand the why. Now, that doesn't mean you necessarily need to go out and know how to do the type of research that we do to develop these strategies. That's what we're here to do. So what our job is to do for our students and for you is to give you the confidence that we know what we're doing. And that's why we publish our trades and why I'm happy to show you my trading account, to show you that we do this like we teach it. For you to have confidence that there are rules, exact rules for you to follow. But then the third thing is having confidence that you can do it. And so that's why we start talking about efficiencies of systems, and why we work with scans. Because for most people, you might not want to sit in front of a computer all day long, building your own scans and your systems and researching all the thousands of indicators you could possibly use. And it's not effective. The most important thing you need to have as a trader is actually to keep it simple, and limit your exposure to all of that information that's out there. So with every single thing that I trade, I'm always looking essentially for the same setup again and again and again. And even though there's 100 patterns out there, I'm really only interested in, I see another one that doesn't fit that model, ignore it. And so when you start to define exactly what you're looking for, then you can build a scan to find it for you. Once you know exactly what you're looking for, you can find it with a click of a button. And that's what we're offering for you today. So this is our proudest moments. We call this market right at the top, and we put together a course which is 4 lessons and 2 hours, at least 2 hours each lesson. You get on demand straight away that will teach you how to find these opportunities with that click of a button. So the first lesson teaches you to scan to your system. If you're using TradeStation or Incredible Charts or Think or Swim or Metastock or Incredible Charts, we have those, or TC2000, we have those already ready to go. If you don't have any of those programs, no problem. We'll tell you the criteria to plug into your system. And if that's still an issue, we can identify free software to use and set it up for you that you just click the button and it'll tell you what stocks are coming up in the scan, and then plug those symbols into your system yourself. So we'll teach you to scan and go through all of the steps of, once you get those stocks coming up on the scan, how to decide how to trade them. What are the rules of trading those? Where do you get in? Where do you get out? In terms of applying the strategy, or how do we pick the options? And you'll actually see one of the lessons that is in that course was recorded right at the peak of the market when we called the head and shoulders in October. So you'll actually get to see, we're actually telling the truth about that. You can watch the recording, and that's where we went and picked all these stocks that most have been 400, 500, 600, some 1,000% returns. And you'll be able to see the analysis where we go in and pick them in the first place. So all of this is very applicable now, and we look for another 200 points, potentially more, as another leg down. And there are stocks every single day that are just starting these types of declines, like Carter's, like Amazon, or rallies such as NUGT and gold. And what comes along with it is, once you register, you'll get the option to have access to our alerts. So that's our text message alerts, our executive summaries, and we do a live class every Tuesday, Thursday for an hour, where we analyze the markets and talk about what we're going to be trading and why, what the global risks are, where the markets look like they're going. And that's $9. You can try it out for a month and follow along with the trades that we're doing. So you'll have instant access to that. And of course, that we have a live class tonight, which is going to be very exciting as we review all of the positions that we're holding, our entry, exits, and stops, and any new ones we're looking at for tomorrow. So you'll get instant access to our current report with those setups, as well as an invitation for tonight. And plenty of time to ask all the questions that you may have regarding what we're doing next and so forth. Okay. Just a quick summary of what's in the course. I may have missed some questions here in the audience. I'm sorry, I've been talking away. How do you know what strike price and date is best? If we're looking for most of these stocks that we're looking for a 30% or more decline in the stock. And so what we'll generally do is we'll look for an out of the money put that's say 2 or 3 months out for expiration, and go about 10% below the price. So we're looking for an implied volatility between 30 and 50%, and then get an out of the money put is something that we're very confident of. Okay. Question, is the smart money indicator included? Yes, it is. Yes, we have the Twigs money flow indicator included and programmed into basically most of all the mainstream programs. All right, well, we're going to have to wrap this up here in a second. I'll leave you with the with some of these emails we've gotten recently. I'll fast forward here. A lot of the students' main reason for that it's because through the course that you go through, it is a fully self-contained course where you will learn everything that you need to be able to trade these opportunities. So leave you with the link there. Sorry, that's actually not Toast. It's actually the one there at the bottom, tradethirsty.com/pub. And we look forward to a very, very exciting month ahead. And this is just the very, very beginning, ladies and gentlemen. So I'd like to thank everyone there at Trading Pub for having me on. And I hope that the information I've covered is of value. And if you have any questions, feel free to drop us an email or give us a call. And I look forward to working with you. Thanks, everyone.